I want you to slow down for a second before you even think about charts, price targets, or predictions, because what's happening right now in the background of the global economy is far more important than any single candle on a screen. There's a narrative floating around that everything is fine, that markets are strong, that risk is behind us, and that crypto is just waiting for its usual cycle to repeat. That narrative sounds comfortable. It also ignores a growing number of signals that something much larger is rearranging itself behind the scenes. Right now, you've got record equity highs, gold breaking out, silver surging, and at the same time, the public feels squeezed. Surveys show more than half of Americans believe we're already in a recession. Job cuts are accelerating, corporate balance sheets are shifting, and yet the major indices keep pushing higher. That disconnect matters a lot because that kind of divergence rarely lasts forever. Either the public perception catches up to the markets, or the markets eventually catch up to reality. History doesn't give us many soft landings when those two drift too far apart. At the same time, some of the largest players in finance are quietly making moves that don't fit the everything is normal story. We've watched corporate treasury strategies evolve from conservative cash management into aggressive digital asset accumulation. And what started as a niche experiment a few years ago has now turned into a full-scale shift in how certain companies are thinking about reserves, liquidity, and long-term positioning. These are not emotional decisions. These are structured, board-approved balance sheet strategies. And here's the part most people underestimate. These moves are not being made in isolation. They're happening alongside a major macro pivot from central banks. Rate cuts are back on the table. Quantitative tightening has already ended. Liquidity conditions are shifting. Whether people want to admit it or not, the cycle is turning again. The question isn't whether liquidity returns. The question is where it flows first when it does. This is where digital assets re-enter the conversation in a much more serious way than during the last cycle. The infrastructure now exists. Custody solutions exist. Regulatory frameworks are being drafted instead of blocked. Banks that once rejected crypto outright are now preparing to support it operationally. That change alone completely reshapes how capital can move when risk appetite comes back. Now here's where things get uncomfortable for a lot of people. The public still debates whether crypto is real, while some of the largest institutions in the world are quietly preparing to use it as part of their financial plumbing. That gap between public perception and institutional preparation creates opportunity, but also massive volatility, because when positioning is this uneven, the eventual repricing tends to be sharp, not gradual. We also need to talk about the economy beneath the surface. Job cuts this year are already among the highest in over a decade. Artificial intelligence investment is propping up large portions of growth. Data center spending is exploding. Semiconductor demand is being pushed beyond optimal efficiency just to meet capacity. That kind of growth can look powerful on paper while simultaneously becoming fragile underneath. We've seen that movie before. It usually doesn't end quietly. What makes this setup even more complex is that we're not simply dealing with a market cycle. We're dealing with a systemic transition. Payment systems are being modernized. Bank settlement layers are being rebuilt. Cross-border money movement is being redesigned for a digital age. These are structural changes, not speculative trends, and structural changes move slowly until suddenly they don't. This is why you're seeing so much conflicting information right now. One headline screams economic collapse, the next screams new all-time highs. One analyst says the next crash is imminent, another says a new expansion is just beginning. The truth is likely messier than either extreme. Transitions almost always are. They create periods where risk and opportunity exist at the same time, and that's exactly where we appear to be sitting. So as we move through this video, I want you to frame everything through that lens, not as a short-term trade, not as a social media narrative, but as a broader liquidity and structural shift that's been building for years and is only now becoming visible to the public. Because whether you realize it or not, what happens next is not just about price, it's about positioning. Who is early? Who is late? Who understands what's actually changing under the hood? And who is still debating yesterday's headlines? And that's exactly what we're breaking down today. Now let's talk about the part of this puzzle that most people pretend to understand, but very few actually track properly: liquidity. Because at the end of the day, liquidity controls everything, not narratives, not influencers, not even fundamentals in the short term. When liquidity expands, assets inflate. When it contracts, everything bleeds. And right now, whether people want to admit it or not, the global liquidity cycle is shifting again. Quantitative tightening is finished. That alone is not bullish immediately, but it removes the largest headwind the market has faced for years. At the same time, the probability of rate cuts is no longer theoretical. It's being openly discussed, priced in, and signaled by policymakers. This is exactly how every major easing cycle begins. First denial, then hesitation, then slow acknowledgement, and finally full acceleration. Here's the uncomfortable truth most people miss. Rate cuts don't happen because the economy is strong. They happen because something is starting to strain. Central banks don't ease policy out of generosity. They ease because pressure is building somewhere in the system that cannot be relieved any other way. So while markets may celebrate the idea of cheaper money, the reason behind that shift is almost always stress. What makes this cycle even more dangerous and more explosive is how uneven the stress actually is. On the surface, you see equity indices making new highs. Underneath, you see job losses accelerating, corporate restructuring increasing, debt rolling over at higher costs, small businesses struggling while large corporations concentrate more dominance than ever. That is not a healthy balance. That is a system absorbing pressure in some areas while hiding it in others. This is why people feel confused right now, because the signals conflict: strong markets, weak households, strong tech spending, weak consumer confidence. That divergence is not stability, it's tension, and tension always resolves one way or another. Now let's connect this directly to digital assets, because this is where the average investor still gets lost. When liquidity expands, it doesn't flood evenly into everything at once. It flows through channels, first into government bonds, then into equities, then into risk assets, then finally into speculative assets. Crypto sits at the far end of that pipeline. That's why crypto always feels late to the party, but when it moves violently. The difference between now and every previous cycle is that crypto is no longer a fringe experiment sitting outside the financial system. It is being wired into it. ETF structures, custody services, compliance frameworks, settlement infrastructure, all of this now exists. That means when liquidity finally reaches the far end of the risk spectrum this time, it doesn't hit a fragile market anymore. It hits a reinforced one. This is where people misjudge timing. They expect things to explode the moment rates shift. That's not how it works. First comes quiet positioning, then comes institutional testing, then come the early rotations. Only after that do you get the public mania phase. Most people are still mentally stuck in the ETF approval equals instant moon logic. Reality is slower and far more deceptive. And now let's layer the AI boom on top of this, because this is distorting everything. Massive capital is being poured into compute, data centers, chips, infrastructure. That spending is keeping GDP numbers elevated even as other parts of the economy cool. Strip AI out of the equation and the growth story looks far weaker. That tells you the current expansion is narrow, not broad-based. Narrow expansions are fragile. Broad ones are durable. This matters for crypto because narrow expansions tend to break violently when sentiment shifts. And when they do, central banks do not hesitate. They flood the system. That flood is what historically lights the fuse under alternative assets. Now here's where the psychology flips. Right now, fear dominates the middle class, but confidence dominates capital. That tells you something very important. Smart money is positioning early while public money stays paralyzed. That is exactly how every major wealth transfer begins. When people say the billionaires are buying, they often miss what that really means. It doesn't mean they're bullish on price next week. It means they're planning for a structural shift over the next several years. These are not day trades. These are liquidity hedges. These are balance sheet hedges. These are dominance plays. And XRP sits uniquely inside that structure. It is not positioned as a meme asset. It's positioned as settlement infrastructure. That makes it react differently to liquidity expansion than purely speculative tokens. When capital returns to speculation, it chases momentum. When capital returns to infrastructure, it chases utility. XRP sits at the intersection of those two flows. That's why this setup is so dangerous for traders who think in straight lines, because the early phase doesn't reward impatience. It rewards positioning. It looks boring. It looks frustrating. It looks like nothing is happening. That's the same phase where most people get shaken out before the expansion actually reveals itself. So if you're feeling confused right now, oh, that's normal. If the market feels irrational, that's expected. If price action feels disconnected from news, that's typical at cycle inflection points. The mistake is assuming disconnection means weakness. In reality, disconnection almost always signals transition, and the people who profit most from transitions are never the people who feel comfortable inside them. Now let's talk about the part everyone keeps oversimplifying: the actual behavior of billionaires, treasury companies, and institutions right now, because this is where most retail narratives completely break down. People see a headline like another billion-dollar crypto purchase, and they assume it's some kind of coordinated pump scheme. That's lazy thinking. What's actually happening is far more calculated, slower, and more dangerous for anyone who isn't positioned correctly. Treasury-style accumulation is not a YOLO bet. It is not emotional. It is not based on price candles. These companies operate on multi-year balance sheet strategy. When a company converts hundreds of millions or billions into crypto, they're not trading. They're restructuring their asset base around what they believe will outperform currency debasement over the next decade. That's the key detail most people miss. This isn't about beating the market this quarter. It's about surviving and dominating the next monetary regime. Michael Saylor's Bitcoin purchases aren't speculative anymore. They're defensive. Ethereum treasury buys aren't trend chasing. They're positioning for settlement layers, tokenized finance, and programmable collateral. And now you're starting to see XRP quietly entering that same conversation through payment infrastructure, on-chain settlement, and cross-border liquidity plumbing. That's not retail territory. That's nation-state and institutional plumbing. What makes this phase deceptive is that price doesn't immediately reflect balance sheet behavior. A billionaire can absorb hundreds of millions through OTC desks, private allocations, derivatives, and structured products without moving the chart much at all. Public price only moves when supply on exchanges starts drying up faster than demand can be matched. That's always the last phase, never the first. So when people say, if institutions are buying, why hasn't price exploded? The real answer is simple, because they're not done yet. Institutions don't buy tops. They accumulate during uncertainty. They accumulate during public doubt. They accumulate while retail is distracted by noise. That's not manipulation. That's just how capital with patience behaves. And this is where the idea of orchestrated moves gets misunderstood. It's not a secret meeting behind closed doors where billionaires decide to pump a chart on Tuesday. The orchestration happens through incentives, through regulation unlocking access, through custody infrastructure becoming compliant, through derivatives markets going live, through ETFs getting approved, through treasury policies changing. Step by step, the rails get built. And only then does mass participation become possible. That's what you're watching form right now. Now connect that to the banking system. Banks don't move until they're allowed to. Once they are allowed, they move fast and at scale. Crypto custody, settlement rails, tokenized deposits. Those are not retail toys. Those are bank-grade tools. And once those are live in major jurisdictions, crypto stops being optional for capital. It becomes a competitive necessity. And this is where XRP's positioning becomes extremely uncomfortable for skeptics, because whether someone likes XRP or not is irrelevant at the institutional level. Utility beats opinion. If something settles faster, cheaper, and with less counterparty risk, capital eventually has no choice but to root through it. Now here's the brutal part most people won't say out loud. Retail does not get early notice when institutions pivot. Retail only sees confirmation after positioning is already advanced. By the time price reflects it, opportunity is already partially gone. That's why it feels like they always win. It's not because they cheat, it's because they move before narratives change. And look at the pattern forming now. Treasury-style crypto accumulation is accelerating. Banks are preparing custody services. Governments are drafting digital asset frameworks. Liquidity cycles are turning. Retail confidence is low. That combination doesn't happen often. When it does, it historically precedes violent repricing, not slow appreciation. But this is where discipline matters, because this phase is not about blindly buying everything. It's about understanding which assets sit closest to the pipes of real capital flow. XRP is not competing for meme attention. It's competing for settlement flow. That puts it in a different game entirely. And one more hard truth. Institutions do not need retail to succeed, but they benefit enormously from retail exiting early. When retail gets shaken out, supply consolidates. When supply consolidates, price becomes more sensitive to large capital flows. That's how parabolic moves are structurally formed, not emotionally willed into existence. So the question isn't whether powerful players are accumulating. That part is already obvious. The real question is whether you understand the stage of the cycle we're actually in, and whether you're reacting emotionally to short-term chaos instead of positioning rationally for long-term structural shifts. Because the biggest gains never come when everyone is confident. They come when confidence is fractured and capital is quietly positioning underneath the surface. Now let's bring all of this directly back to XRP, because this is where a lot of people either get wildly euphoric or completely dismissive, and both sides usually miss the real picture. XRP doesn't move like most retail-driven altcoins. It never really has. Its value proposition isn't built around hype cycles, NFTs, or speculative narratives that trend on social media for a few months and then disappear. XRP is tied to infrastructure. That makes its behavior slower to ignite, but far more violent when it finally does. What matters most right now is not today's candle structure. What matters is whether XRP is being embedded deeper into financial rails at the same time that liquidity conditions are shifting. And based on everything we're seeing globally, that integration appears to be accelerating, not slowing down. Banks, payment processors, and governments do not think in terms of price targets. They think in terms of cost reduction, settlement speed, compliance, and systemic risk. If XRP or the XRP ledger can reduce friction in cross-border payments, capital movement, or liquidity provisioning, then price becomes a secondary consequence, not the primary objective. This is why the growing conversation around crypto custody at banks matters far more than people realize. Once banks can legally hold and move digital assets on behalf of clients, the door opens for XRP to be used as a neutral bridge asset rather than a speculative trading chip. That changes who is holding it, how long they hold it, and why they need it. Right now, a lot of XRP volume is still speculative, traders in, traders out, but utility-driven liquidity behaves differently. It doesn't care about short-term volatility. It cares about whether transactions settle efficiently and consistently. If XRP becomes embedded even modestly into real settlement flows, that creates what's known as structural demand that doesn't disappear just because the market dips for a few weeks. And that's where the imbalance can form. You have a fixed maximum supply. You have a large portion of that supply already inactive or locked long-term, and you have a growing probability that institutions, banks, and governments require XRP not as an investment, but as operational infrastructure. That's an entirely different demand curve than retail speculation. On top of that, the conversation around treasury-style crypto accumulation changes the supply picture even further. If companies begin holding XRP on balance sheets the same way they hold cash equivalents or hedging instruments, that supply comes off the market for long periods of time. Not days, not weeks, years. And the market doesn't need every institution to participate for this to matter. It only takes a handful of large players routing significant volume through the same settlement layer to stress test available liquidity. XRP doesn't need global domination to feel the effects of participation. It only needs targeted adoption in high volume corridors. Another layer to this is remittances and on-chain settlement for emerging markets. You don't often hear about this because it doesn't make flashy headlines in Western media, but some of the highest payment friction on Earth exists in South America, Africa, and parts of Asia. These markets move billions across borders daily under inefficient systems. Any tool that meaningfully reduces cost and settlement time becomes extremely attractive to governments and institutions working under tight margins. That is where XRP's design aligns far better with reality than many speculative tokens ever could. Now layer that on top of the macro environment we discussed earlier: rate pivot expectations, banking stress under the surface, AI-driven capital concentration, geopolitical risk, and the quiet construction of digital financial rails. In that environment, assets that solve real plumbing problems tend to outlast assets that exist purely for speculation. This doesn't mean XRP goes vertical in a straight line. It doesn't mean volatility disappears. It doesn't mean the market suddenly becomes fair or predictable. But it does mean the probability distribution for long-term adoption becomes meaningfully asymmetric. And that's what most people struggle to evaluate. They try to measure XRP strictly through the lens of last cycle's chart patterns or meme-driven price targets. But XRP is not competing for meme dominance. It's competing for transactional relevance. That's a slower contest and a far more consequential one. One more point that needs to be said clearly. XRP does not need every bank, every government, and every payment provider to adopt it for the network effects to become meaningful. Payment networks scale non-linearly. A few high-volume corridors can create more real demand than thousands of retail traders could ever mimic. So the real question becomes this: if even a fraction of the institutional, banking, and treasury behavior we're watching today continues on its current path into 2026 and beyond, what does that do to the long-term liquidity profile of XRP? And more importantly, how many people actually understand that transformation while it's still in its early stages? Because by the time the shifts become obvious to everyone, the repricing phase is usually already well underway. Now let's bring this all home, because if you've listened carefully through this entire breakdown, you should already realize something very important. This isn't about hype, and it isn't about guessing some magic top price. This is about positioning yourself correctly inside a shifting financial system while most people are still distracted by surface-level noise. What we're watching unfold right now isn't just another crypto cycle driven by meme coins and speculative mania. This is the slow construction of digital financial infrastructure mixed with massive macro forces, interest rate shifts, bank balance sheet stress, government policy changes, AI-driven capital concentration, and global monetary restructuring. These forces don't move in straight lines. They move in waves, and those waves reshape entire asset classes over time. XRP sits directly inside that intersection, not because of hype, not because of social media narratives, but because it was designed to solve a problem that actually exists at scale: the movement of value across borders efficiently, cheaply, and instantly. That's not a toy use case. That's a foundational layer of the global economy. But here's the real talk that most channels won't give you. None of this is guaranteed. Not adoption, not institutional dominance, not ETF approvals, not price appreciation. Anyone who tells you otherwise is selling certainty where none exists. Markets don't reward blind belief. They reward disciplined positioning and patience under uncertainty. There will be pullbacks, there will be regulatory delays, there will be geopolitical shocks. There will be moments where narratives shift against XRP again, just like they have many times before. And some people will fold during those moments, just like they always do. That's not an insult. That's simply how human psychology behaves under pressure. The people who survive long-term are not the ones chasing dopamine. They're the ones who understand why they hold something, what risks they're taking, and what conditions would make them change their thesis. If your reason for holding XRP is only a price target, you're exposed in ways you probably don't realize yet. The smarter framework is this. You hold because you believe liquidity rails are being rebuilt. You hold because you believe legacy systems are being modernized. You hold because capital always flows toward efficiency over time, and you accept the volatility as the entrance fee for that transition. And if you don't believe those things, that's fine too. The market doesn't require belief. It only reveals who was positioned correctly in hindsight. But what you cannot afford to do is drift through this next phase of the market without a framework. Because when volatility returns at scale, emotion will destroy unprepared portfolios faster than any regulation ever could. So here's the only responsible message to leave you with. Do your own research. Question every narrative, including mine. Never invest money you cannot afford to hold through extreme drawdowns. And never confuse speculation with certainty. Nothing in this video is financial advice. This content is for educational and informational purposes only. I am not a financial advisor. Always consult with a licensed professional before making any investment decisions. If you gained value from this breakdown, show that support through a like and subscribing. It helps the channel grow and keeps this content reaching more real XRP holders who want more than just noise. Drop your thoughts in the comments. I genuinely read them, and I'll see you in the next one.